Good morning, everyone. Appreciate you checking in for this week's Coffee with Kirk. I know you probably have better things to do in the summertime, but appreciate your time. And we're going to jump in today and talk about a couple things. The first one's really the main topic. And what I'm looking at there is just going to almost work through with you all some ideas I have for client portfolios, and specifically really focusing on risk management. See, the problem I always have as a financial planner is almost everybody's focused on one thing, the return. Nobody focuses on the risk until bad things happen in the stock market. Then everybody's concerned about risk. So while the markets are good, I'm always trying to justify why we have certain asset classes and, how I might have a little bit more conservative posture or something like that. If the S&P 500 is up 25% and their account's 16%, they're not happy. So I'm always trying to say that, return is only one part of your total portfolio allocation and operation. Risk is the other one. And, we're in a situation right now, if you've been following anything I talk about for a couple of years, there's really no logical valuations for any asset class right now. But stock market, I'll show you here, is ridiculously overvalued compared to history. The bond market obviously isn't, with yields being so low. You really aren't even keeping up with inflation anymore. Real estate has kind of been bad, but it's just off the charts ridiculous at this point. So, every asset class is kind of, looking bubble-ish. And in the past, when we've had bubbles, they've been one-off bubbles. They've been a traditional bubble, something like got misallocated. Like in the 1860s through the 1880s, it was railroads. Everybody invested in railroads. But other sectors of the economy were quite cheap. And then, of course, we had, during the tech bubble in 2000, tech was ridiculously expensive. But there were sectors of the stock market that were downright cheap. Utilities at that time, some value stocks, consumer staples, they were left for dead. No money was going into those companies. It was all going to tech. So had you bought those in 99 or 2000, those sectors, utilities, consumer staples, some hardcore value, you would have done really well through the 2000 to 2002 bear market. So that doesn't exist today. There's really no sectors that are really cheap. We talked about oil. I think oil and commodities, but oil in particular, is kind of a cheap area and still is, even with the recent increase. But it's not kind of back the truck up kind of cheap. It's just, it's reasonably priced. So how do we handle this? If the traditional way to manage a portfolio is to essentially, you've got stocks and then you've got bonds, and they've always served as a counterweight to one another. But, bonds have always served a couple different purposes. One, that counterbalance the stocks. And I think that still exists today. If the stock market goes down, money will run to bonds. But the second part of bonds traditionally has been yield. You do it to get some investment interest. But you're just not getting anything right now, at least nothing that's even keeping close to what inflation is. So if bonds really aren't serving the total purpose that they have usually done, could we do better? Yes, the stock market's overvalued, but is it possible to put more money into the stock market and maybe specifically allocate towards higher dividend paying stocks to sort of take that interest that bonds used to provide, maybe get a little more interest on your stock portfolio. So you've kind of recreated that part for the bonds. But then also maybe get some long-term capital appreciation if this market continues. So you can maybe move to some dividend paying stocks, get a little extra yield over what you could get on the 10-year treasury, and then possibly get some capital appreciation on the price of the stocks. But of course, with the stock market at historic highs relative to historical valuations, maybe that's dangerous. Maybe you're just setting yourself up for a bigger fall. But what I've been looking for, is there a way to kind of counterbalance this? Is there another way to manage the risk? So we know maybe we can get more return by doing a little bit from bonds into higher dividend paying stocks, but how do we manage the risk? And that's what I'm talking about today. And I don't have the perfect answer yet. I'm still doing research because it is something new that I'm doing. And it does involve stepping into a consistent allocation to some futures markets. So it's a little bit trickier. I'm going to start off with a video. I was going to get into a lot myself of the basic thought process here, but there's a great video I'm going to show you. It's 5 minutes, and it's Mark Spitznagel. He manages a hedge fund that's been around forever, and they've done really well managing risk. So their risk-adjusted return has been fantastic. And he's one of these mathematical guys. He was one of the first that opened a fund that what they call quantitative, a quant. So it's all mathematical based. And he kind of has a way to figure out how do you manage the risk mathematically, but yet still try to get a little bit of a higher return. So I'm going to play this video, again, real short, and then we'll jump into some of my slides and to kind of further the points you'll see here in this video.
The returns versus risk battle is the front line of investing. We all want higher returns with lower risk. But of course, the two are seen as a trade-off. Traditional asset allocation deals with this by striking a balance between risky and less risky assets, typically between stocks and bonds. Think of your portfolio as a pie. We can slice it into different pieces by these different allocations, the size of each piece representing its relative size in your portfolio. An allocation of 60% to stocks and 40% to bonds is a pretty standard, simple pie in the investment world. The idea behind this typical weighting, as you can see here, is that these two slices, stocks and bonds, balance each other in terms of their risks, as they typically go up and down in opposite directions, or at least don't often collapse together. So over long periods of time and over many environments, this combination should do pretty well, hopefully better than average. Some take this balancing act even further, adding more slices for credit spreads, real estate, emerging markets, and so on. And many smart people with all kinds of complicated formulas and forecasts and a lot of capital work to fine-tune this intricate balance. But simple or complex, the point here is the same. The problem is, all this fine-tuning doesn't always work out so well. All of these slices at times can get distorted and manipulated into bubbles as central banks compress interest rates and lure investors into ever riskier assets. There's immense pressure to add to the slices with the highest yield and best performance, and we find ourselves chasing the most immediately gratifying as well as the most expensive and riskiest assets, and ultimately succumbing to these serial bubbles. We even find ourselves here today, where not owning enough high-returning assets like stocks feels foolish, like missing an opportunity, though a very, very risky one. So what do? There must be a better way than this to allocate capital and manage this presumed trade-off between returns and risk. Well, there is. What if you could take a tiny sliver of a slice of your portfolio pie and invest in something that does even better when the bigger slice, stocks, goes down? Notice how profits in this tiny slice essentially cancel out the losses in the stock slice. This loss cancellation allows you to actually take more risk in stocks. And of course, being such a tiny slice, it couldn't hurt you much when stocks rise, especially compared to what you gain with your larger stock position, no matter how far that sliver goes down. This sliver thus acts very much like an insurance hedge, hence the name tail insurance or tail hedge. By allocating, say, just 1% of your portfolio to the tail hedge sliver, as Universa does by owning put options, You could go from a 60-40 stocks bonds mix to a much greater stock allocation, and yet your portfolio's total risk would go down. The key here is the tininess of that sliver relative to how much it can make when stocks go down, or in financial parlance, the asymmetry of that position. This means that when stocks go up, it only costs a very small amount on its own relative to what it can make when stocks go down. This asymmetry is challenging to conventional asset allocators, as it just doesn't fit in with their conventional models. It even creates what looks like a paradox. How can higher returns possibly come from lower risk? Whatever happened to the trade-off? The real challenge here, as well as the real opportunity, lies in a misperception. When looked at in isolation like this tiny slice will look like a disadvantage when stock markets rally. However, as we saw, when looked at holistically within the context of an entire portfolio like this, it becomes clear what a huge advantage and transformation it can create. The tail hedge allows for a bigger slice of stocks in the investment pie than the 60-40 portfolio because the stocks are protected in a steep sell-off. The tail hedge portfolio thus indirectly and counterintuitively beats the 60-40 portfolio, as well as most alternative investments and other supposed low-risk things. And as you can see here, it beats them when stock markets rise and when they fall. And, importantly, after the fall, when everyone else is selling their stocks, notice how the tail hedge has created all this cash or liquidity to use to invest in more cheapened stocks. And this is cash you would otherwise have only if you had started with a much smaller stock allocation. So you can see how that tiny sliver of a hedge, in its own indirect, roundabout way, in up and down markets, can be the driver of consistently higher returns for the entire portfolio. Investing this way is what I've been doing my whole career, and it's precisely what Universa did for clients in the 2008 crash and in the rally that followed. Moving from a traditional stock-bond balanced portfolio to a tail hedge portfolio requires viewing asset allocation and risk in a different way, holistically rather than reductively. But when looked at in this way, there is no trade-off, there is no paradox, and higher returns really can come with lower risk.
Okay. So hopefully that gave you, it was a really good intro to kind of what I'm looking at and trying to figure out. In that video, they use something called put options. So put options are basically you're expecting the market to decline. So you buy an option that as the market declines, you basically are going to make money. So it's betting against the market. Kind of like shorting the market, but you're doing it through the options. What I'm looking at as a core holding isn't quite as volatile as the put options, but it's focused on volatility. So when the market goes down, it gets more volatile. And there are actually options out there based on a volatility index. So it has kind of the same effect as a put option. It's not quite as volatile as put options, and it isn't completely diametrically opposed. So obviously the put option makes money when the market goes down, makes nothing when the market goes up. Volatility options can make money when the market goes up if the market is more active and more volatile. And it may not completely track a downturn in a market because maybe the market will just come back without large volumes, without large volatility. It could just be kind of a slow descent. But historically, it's been a pretty good counterbalance. So I'm just going to show you some slides that kind of give you, sort of expand on what we just watched. Share my screen here real quick. Okay. So again, one of the big reasons that I'm looking to do this is half of the twofold reason to invest in bonds is kind of gone. The treasuries, this is looking at the 10-year treasury over a long period. And you can kind of just see how yields have just continually been declining all the way back from the peak back in the late 70s, early 80s when it hit almost 16%. But you're just not getting any kind of yield anymore. Now, you still have that counterbalance to the stock market. So bonds are still a very valid asset class and should be used. And you are getting some interest. It's not as if you're not getting anything, but 1.5%, that's not really all that great. The other thing, I talked about, and I think Spitznagel did as well, that people are reaching for yield, they're reaching for more return because that's what you have to do during bubble periods. And this just kind of shows you that the spread between junk bonds and treasuries is now hit an all-time low. So you can just see that people are buying tons of junk. It has brought the yield on it all the way down to only a 1.5% above the rate of a treasury. So, that's dangerous. That's really dangerous. A lot of these junk bonds really have normal volatility equal to the stock market. So when you go into the junk bond market, which is why I never do, you can actually experience the kind of volatility that you would in the stock market. And you can kind of see that here. Now, it would have been, the only time it would have been great to get into junk bonds would have been in 2009, when you had a 14, almost 15% spread between treasuries and junk bonds. And remember, treasuries back then were still yielding 5.5%. So you're looking at a 20% return on junk bonds at that point. But right now, it's just not there. So you could argue that bonds are really as overpriced as anything. And then we've talked about inflation. We've talked about how I see it kind of coming back. It's really sort of accelerating. This chart just, again, gives you an idea of how we've seen it really grow since we've gone off the gold standard in 1971. But this is a chart just showing you the 10-year treasury spread relative to inflation, going back to 1960. So you can kind of see that, historically, you're going to get some sort of premium above inflation for investing in a bond. A bond typically is going to give you a little bit of a yield above inflation. Now, we didn't have that in the 1970s, and it's been really low. It's been below that for the past decade, but it's getting really bad at this point to where, you're starting to see some negative returns relative to inflation. In fact, this gives you another chart by the decade. You can see on the far right what the inflation rate was over that decade, and then what the spread was between the treasury yield and inflation. So back then, if in the 1960s, inflation 2.4, so you would have earned 4.7% typically on a 10-year treasury. Counter that with the 1970s. And then even the 2010s have not been a good place to be. You've had a positive 0.6 spread. So you've been a little bit above inflation. But what we're witnessing, at least right now in the short term, this year, and I think for maybe next few years possibly, is a negative spread. So you actually lose money. You're not even keeping pace with inflation. So again, that's one of the reasons I'm looking at this, just because bonds are no longer really serving as the counterbalance in the yin and yang as it typically did with markets. But again, the market is not by any way cheap. So this is something that you don't want to just sell bonds and go into stocks, because now all you've done is you've increased the risk of your portfolio substantially, and you don't know what the markets are going to do. So you've increased the risk. You might get lucky and get the higher return that we think equities will provide over bonds. But you may be just shooting yourself in the foot and find out a year from now that you've just made a monumentally stupid decision. So you have to make sure you're always focused on the other side of that portfolio metric of risk, the other side from return. This is something I've shown several times. It's what Warren Buffett looks at to determine fair valuations of the market. And what this does is it takes the market cap of all the publicly traded stocks in the US and divides it by our gross national product. It's another way to measure the economy. So it's basically saying is how much is the stock market compared to everything we produce in the economy? And this isn't just all that is produced by the publicly traded companies. This is all the small businesses, the mid-sized businesses, the non-publicly traded companies, the entire size of our gross national product or our economy. So, you know, you can kind of see we're in nosebleed territories. I mean, back in 2000, we hit a level that's never even been close before. When we broached that 200%, we were, I think, at 190%. And then at the 08 crash, we hit 150. And of course, right now, we've just gone well past 250%. So the stock market is now valued at 2.5 times the size of the economy. So it's not cheap. You know, this is just kind of nuts. Just another chart. I usually use a lot of John Hussman's data, but here again, he's kind of showing, you know, he has a metric that he looks at for price to earnings that he massages, and it's been a pretty darn good predictor of future returns. And he'll admit that in the short term, these valuation metrics mean nothing, but in the long term, they do give you a good idea of what you could expect from the market. So the blue line is his valuation metric, and the red line is the ensuing future 10-year returns or subsequent 10-year returns. So the only places you actually have sort of deviations from that is when you either have a really cheap stock market, like we saw in the 1930s, and then again in the late 60s and early 70s, or you have overvaluations like we did with the 2000 bubble, the 2008 bubble, and now, of course, what we're experiencing now. And you can kind of see the deviation between the red and blue at this point has never been higher. So again, kind of expecting some pretty low returns going forward. In fact, if you look all the way to the far right at the blue there, if you were to follow his metric, you know, he's saying that based on metrics alone, we could expect possibly a negative 5% annualized return for the stock market over the next 10 years. So again, it's not a no-brainer to say, oh, bonds aren't yielding, let's go to stocks and have some fun, because there's a lot of risk everywhere. This is just one more chart. This is just showing the price to sales. So this isn't even earnings, this is sales. So sales are gross sales. It's what you bring in, and then you pay all your expenses to get to your earnings. So just based on price of sales for technology, it is now well past the peak of 1999. So again, what I'm kind of talking about here is looking at reconfiguring portfolios a little bit to go into more dividend-paying stocks to get the yield that we're basically losing from bonds, but to do it in a fashion that's not going to cause us to increase the risk of the portfolio substantially. And there's a lot of different tools that are out there. You can use puts. You can have funds that do long short. So sometimes they'll be long in some stocks and short in others. But this one's looking at volatility. So volatility has a pretty negative correlation to the stock market. So when stocks are going down, people panic and sell, so volatility goes up. Again, it's not perfectly correlated, but it does do a pretty good job of providing protection. And this is just a chart of the ProShares midterm futures ETF. So midterm futures just means it's going to be longer than 3 months of a futures contract. And what you can see here is so far this year in 2021, this holding is down 36%. So you're probably wondering, like, why would you invest in something that's down 36%? And that's what's going to happen when the market's going up. These vehicles are going to do nothing but deflate. They're not, for the most part, you could have higher volatility in the market going up. That can happen just with the amount of trading could just increase if everybody wants to get in. That could increase volatility. But for the most part, again, that counterbalance, this is something that is guaranteed to lose money when the stock market's doing well. So you can kind of see all the way to the far left of the chart from 2016 to 2018, this thing just drained money. That was it. And then kind of went sideways from there because we had a negative market in 2018 and we had a period in 2019 where it's some up and down. But then look at 2020 and see that large spike up. So when Corona hit and the market dropped 35% in short order over a 2.5 month period, this thing went up 120%. So you had the stock market going down 35. This went up 125. So you can kind of see how you get that asymmetric return that Spitznagel was talking about. So when this thing does work in your favor, it really works in your favor. You get a sizable increase in the performance relative to what the stock market's doing. You know, in this case, we had a fourfold increase in this ProShares VIX midterm futures ETF compared to what the market did. And then just to give you an idea of how has long volatility done over different periods. And I've used these charts before. This is for Artemis Capital Management. They put together a really great paper, and they broke things into different periods. So going all the way back to 1929, all the way through, this goes through 2019. So you can see during the Great Depression, long volatility was a very good performing asset. But then when we had the post-World War II boom, it didn't do so well. It kind of flat. I mean, it was up a little bit, but not that great. But then in the 60s through the early 80s, when we had bad stock markets in the 70s, long volatility over that period, that 19-year period, did quite well for you. But then we had from 84 to 07, you can see it was just a complete loser. Again, stock market did great from 1981 until 1999, and then did well again from 03 until 07. And then from the last period there, you can see long volatility helped you obviously in 08 and 09, but then since then, it's kind of just been sort of a drag on your portfolio. But just to give you kind of an idea of the little 2020 bear market we had, just to show you sort of how this thing could work and the kind of, I guess, kind of the benefit you'd get from it. So this is just if we went into a very simple calculation here, 60-40 portfolio. So 60% is going to be invested in the S&P 500 as denoted by the SPY, that's the ticker symbol. And then the rest is going to be in intermediate term treasuries, which the ticker symbol for that is IEI. So you can see during the bear market, the stock market again lost 35% in that short period, whereas intermediate term treasuries returned a positive 5.6%. So based on that 60-40 allocation, a diversified portfolio that way would have lost 18.76%. Now, nobody likes to lose money, obviously, but if you're looking between 35% down and 18% down, I think most people would be happy with only losing 18%. That's how that performed. So then let's take a different tack here. So now we're going to change the portfolio completely. And we're going to have 90% in the S&P 500, again, denoted by SPY. And we're going to put 10% into the volatility index. And you can see the returns, again, negative 35% for SPY, but 125% return over that period for the VIX. So you basically still end up with a negative 19% return, same as a 60-40 portfolio, but you had 90% allocated to stocks. So in a downturn, just a small allocation to that, to the VIX, is going to give you pretty much the same effect that you would get from the bond market. But you still have 90% in stocks when the markets do better. Now, if you take 10% to the VIX and then still have some bonds in there, your downside would have been limited even more. So how's it done this year? So we saw how it just did for a down year. Let's compare apples to apples here. So we're going back to that 60% S&P 500, 40% intermediate term treasuries just so far this year. And you can see the S&P 500 right now is up 16%, but the bond market is actually down 1.4%. So with that allocation, a diversified portfolio is going to be earning about 9% so far this year. Pretty good, right? Now, a lot of people, like I said at the outset of this presentation, they'll look at me and go, why aren't we getting 16%? Well, it's because we're trying to manage risk as well. And we're trying to get some interest. Again, bonds still do offer some interest. But let's look at what the S&P 500 and the VIX index is doing. So again, 90% SPY and 10% into the VIX. So SPY again, up 16%. The VIX is actually down 16% so far this year. But the total return based on that, because only 10% is allocated to the VIX, you're up 12%. So we've increased the return by 3%. And as you saw previously, we basically had the same risk mitigation on the downside. So if the market really tanked, you're pretty much going to get the same effect holding 10% in the VIX as you are having 40% in bonds. So you have a little bit more of an upside potential with this without taking more on the downside. And, as I mentioned, I'm still looking at how do we really put this together. I'm not going to go all out of bonds straight into the VIX. I'm going to add some VIX, sell some bonds, and put some of the bonds towards stocks, some of it towards the VIX. So we should get a dynamic here that maybe we'd only be up 10.5% so far this year. But on the downside, we'd have even more protection. So that's what I'm kind of trying to figure out right now. And again, I'm using data from the past. Who knows what's going to happen going forward? We could have a situation that if bonds lose value because maybe inflation gets so hot that the Fed's raising rates and bonds are losing value, which also is going to probably kill stocks. If you remember the 1970s, that's exactly what happened. Bonds were losing value as interest rates went up, and the stock market tanked because interest rates were going up. So what happened there is you had a situation where both asset classes, fared poorly. But that's where you hope that the VIX would provide some sort of protection there. And remember, I always still use some risk mitigation on stocks with that 200-day moving average. But when you have hot markets, sometimes you have the markets move quite a bit above the 200-day, like we did in 2020 when the COVID hit. I think the market at that time was up, I want to say, like 12, 13% above the 200-day. So following just the 200-day, you lose 13% right there. So it was really high relative to the 200-day moving average. So, risk mitigation is always the biggest part. I always use the Warren Buffett theory of investing. Rule number 1, don't lose money. Rule number 2, remember rule number 1. So we're always trying to focus on that. Even in long-term situation, risk mitigation is important. So that's kind of what I'm looking at. I'm working through. I just wanted to kind of present this to all of you so that when I do it, and if the market continues to go up, and you're looking at this volatility index that I put into your portfolio, and it's just losing value, and you're like, what are you doing? Why are you not selling this? You start to understand kind of why I'm not. Okay, so that's something I'm looking to do. I'm still working through it. Fortunately, right now, volatility index is really, really low. So I don't feel pressured to jump in right away. So I've got a little time to do some more research, some more data analysis, and probably try to get something in place here soon. I wanted to go through, I got a couple questions back. After the last presentation, I talked about real estate, and I just wanted to go over some of the slides I went through before people kind of requested it. As I said last week, real estate's it's ridiculous. It's totally ridiculous. And it's not just from the buying aspect, but from rents as well. So, I mean, we've got a position right now where rents are relative to wages are just historical highs. And things like this just cannot continue. It absolutely can't. Right now, the average household, I think average rental unit has, I want to say 1.8 people per rental. So a lot of people that rent, they just live on their own. Then some have 2 people, and then some have more, but typically I think it's 1.8. So if rents stay up this high for a while, what's the natural thing that people are going to do? Well, for young people, they're going to say, well, you know what, I'm not too thrilled about this, but I'm going to take and add another roommate. We're going to figure out a way to share this apartment. So that 1.8 figure might go up to 2.5 or something like that. So now you'll get a situation where rental properties will come down and prices will follow with that. A lot of people have been saying, people question, like, the home building since the 2008 bubble has been lower than historic averages, and that is absolutely true. They have not been building as much, so they try to justify the prices of real estate saying that we haven't been building as much. There's some truth to that, absolutely. But on the flip side of that, I would say the bubble that we had from 2002 to 2007 in real estate, they were building way too much. So the supply that was put onto the market during those periods was so much that really we needed to have a period after where the building wasn't keeping up with historical norms, just to absorb the supply. So we've clearly absorbed the supply, and we're starting to see builders really try to ramp up. So I think we have a situation where things are going to get a little interesting. So that's on rents. And another chart here for rents that I showed last week. This just compares the median asking rent compared to the consumer price index. So you can kind of here again see that had housing kind of stuck with inflation, or what we use for inflation, we're blowing that thing away. So something's got to give here, folks. And then this is for actual purchases. So the purple line here is the purchases. The red line is average hourly earnings. I've always said that the most critical factor for the real estate market is prices versus incomes. I don't care that back in 2002 through 2006, we had exotic mortgages, we had crazy mortgages. The real reason it all imploded was because home prices became too far separated from incomes. And that's exactly what we're seeing again right now. That's the critical number. It wasn't the crazy risky loans. That didn't help, but that wasn't what really did it in. This was another chart I showed, and this is actually a few, probably a few months old here. And this goes back in the 2006 peak. You could see people were paying 7 times their annual income for a home. Now, this chart again is a few months old. We have now actually eclipsed that figure. So people are now spending north of 7 times their annual income to get into a home. This is the critical factor. It's like earnings for stocks. At some point, the market's going to come into line with what the earnings of a company is. That's the same thing here. Home prices are going to come into alignment with your income. It has to happen. And the fact that we've kind of hit the lows on mortgage rates, I just don't think that we have any tailwind left there. There's no more, juice to squeeze. So at this point, it's all based on the incomes. And when you buy a house, even if you get into conventional, maybe not a conventional where you have 20% down, but you get into an FHA, you put 3% down. If you're spending 7 times your income on this, if anything at all happens to your income, and I'm not even talking a job loss, I'm just talking maybe a downgrade, or maybe you're in a commission-based job and the commissions are sizably reduced for whatever reason, slower economy, but you still have an income, you're going to end up having problems. You're going to have a crunch with your cash flow. And that's going to create havoc. And the other havoc that could happen is we've been going on for a long time without any kind of foreclosures. So we have a huge supply of homes that could come on the market if this moratorium ends. So I just wanted to address that real quick because I did get a couple of questions after the last presentation. I want to finalize, always do this, the disclaimer, lawyers say hi, yada, yada. Okay, so let's jump in and see if there's any questions. Take a look here. Doesn't look like there's any questions. So it looks like I have effectively put you all to sleep, or it has been so good that you have absolutely no questions whatsoever, which is extremely rare for me. I think that video was really good. I think it did a nice job of kind of laying out the framework. Spitznagel's been doing this for a long time. If you want to get your nerd on, if you really want to learn more about it, there's a gentleman out there, Nassim Taleb. He's written some books on this. Really interesting guy, but he kind of talked about it. Anti-Fragile is a really good book to read on that. But he gets into different ways of looking at risk and how important it is. And he always talks about asymmetric returns with tail hedges. So you put something in place that it's not a big part of your portfolio, but when things go awry, it tends to really do well, an asymmetric return to the upside. So if there aren't any questions, I will wish you all a happy weekend, and we'll see you back in a couple weeks. And again, if you have any questions, please email me. That's where I use these presentations are based on your questions. I want to make sure I know that if you've got a question and I get a couple more people asking the same thing, it probably means a lot of people are thinking the same thing or had those questions. So again, have a great weekend, everybody. Take care.